There is a lot of focus right now on Warren Buffett's recent interviews and Q&A sessions, and while there has been a ton of valuable lessons in breaking down some of those clips, I recently found a 1999 article written by Warren Buffett in which he makes a scary prediction about the future of the stock market. In the article, Warren Buffett demonstrates some of the similarities between the stock market in 1964 and 1999, and then makes a prediction that from 1999, the next 17 years of stock market returns would be fairly weak, and he was correct. But most interestingly, many of the things that he talks about as indicators of a weak stock market over the next couple of decades are things that we are seeing in the stock market today in 2021. In fact, some of those indicators are in much worse shape now than they were in 1999. And in today's video, I'm going to be making a pretty compelling argument about why the stock market could be negative, or at least produce very weak returns over the next 17 years when adjusted for inflation. But more importantly, I'm going to talk about how you can avoid achieving negative returns in the stock market, how you can navigate a stock market in the environment that we're seeing right now. As always, I put a ton of effort into making this video, so if you do get some value out of it, I would very much appreciate it if you take the 2 seconds to leave a like on the video. And if you want to see more content like this in the future, then consider hitting that subscribe button. But with that said, let's jump into the video. In the article, Warren Buffett starts by talking about the 1964 to 1981 period, a 17-year period, and he demonstrates that the Dow Jones Industrial Average, one of the major indices that we use to track stock market performance, actually only increased 1 point over that 17-year period. It went from 874 points to 875 points over a 17-year period, essentially meaning that the stock market over that period went nowhere. And when you hear that, the first thing you might think is, well, maybe the economy performed really poorly over that period, or maybe the underlying businesses in the Dow Jones and the broader stock market were just performing really, really bad. Maybe profits didn't rise over that period. But none of that is true. In fact, the GDP in the US over that 17-year period increased 370%. And if you look at the corporate profits for the Fortune 500 businesses, the biggest 500 businesses in the world, they actually increased profits by 6 times over that period. So why did this happen? And is this some kind of irrational market behavior, or is this something that we should expect to continue to happen in the future? And it's actually the latter of those two things. And there are certain functions in the stock market and the economy that are important to understand, because they are things that happen over and over again. And even though the economy and businesses within the economy performed extremely well over that 17-year period, it's also entirely rational that the stock market didn't go up over that period. And the main reason why this kind of thing happens is in relation to interest rates. So first, it's important to understand that all investment opportunities in the stock market, in property, in other types of assets such as bonds, all of those investment opportunities are compared relative to each other in relation to how risky the cash flows are. So what's the certainty of the cash flows that those investments can deliver to you, as well as what is the volume of cash flows that those investments can deliver to you. And everything at the end of the day comes back to what we consider a risk-free investment, which is an investment in US long-term treasury bonds. Now, these investments are considered risk-free because the US government has never defaulted on those bonds. There's never been a period where if you bought a bond from the US government that they didn't pay you back. Now, of course, like any investment, it does have some level of risk. Theoretically, they could face a period where they can't pay that back, but it is extremely unlikely. And as a result, we consider that risk-free, but that is used as a benchmark for all other assets from there. For example, if a US 10-year bond is offering you a return of 3% per year, we can consider that the risk-free alternative, that if you didn't want to invest in stocks or property or other assets, you could earn 3%. That 3% becomes a floor and a benchmark for investments in the stock market. So if you're investing in a business that obviously has more risk than a government bond, because the business could fail to pay their debts or they could underperform the expectations of investors, you would demand a higher return than 3%. But as that 3% US Treasury bond rate changes, it influences what return you're willing to accept on riskier assets like stocks. Buffett explains in this letter that the change in interest rates on government bonds acts like gravity to stock prices, in that if interest rates on government bonds go up, then stock prices come down. And there's a pretty simple way that we can think about why this happens, and it is that as that US government bond rate goes up, that risk-free rate that we can achieve, people are going to demand higher returns on their stock market investments, and they will also be more incentivized to sell their stocks and buy the bond, right? If you are investing in a stock and you're expecting to get a 7% return out of that, for example, but you notice that the risk-free alternative is rising from 3% to 4% to 4.5 to 5%, there will be a point at which that 7% or the extra 2% you're getting from a stock is just not worth it anymore. Why would you risk your money in a risky business to make 7% if you can make 5% from a risk-free alternative? And that relationship impacts stock prices in a way that as interest rates rise, stock prices are typically coming down. Another way to think about the relationship between interest rates on bonds and stocks is that as the return of bonds go up, and the return of a bond is its interest rate, as those returns go up on bonds, the return on stocks also goes up. And as the return of a stock goes up, that is another way of saying its stock price must come down, right? If you're going to make a higher return on a stock, you need to be buying it at a lower price compared to its future cash flows. And as a result, as bond interest rates go up, stock prices are forced down. So going back to our 1964 to 81 period example, if businesses became more profitable over that period, but stock prices didn't go up, then we could imagine, without first looking at the data, that it is extremely likely that interest rates rose substantially, causing stocks to have downward pressure, even though the GDP and profits of businesses was going up. And that's exactly what happened. So from 1964 to 1981, interest rates rose from just 4% all the way up to 15%. Further on in the article, which again was written in 1999, Warren Buffett starts to talk about some of the possible outcomes for the stock market from 1999 over the next 17 years. And he explains that we have no idea what interest rates are going to do, how they're going to move in the future. So all we can think about is what will happen if interest rates change in certain directions, if they go up a certain amount, if they go down a certain amount, or if they stay relatively the same. All we know is that the change of interest rates, whatever it is in the future, will certainly have an impact on the return of stocks. So he gives an example. In 1999, the interest rate was about 6%. He says that if that drops to 3%, or if it was to drop to 3%, then that would immediately double the value of stocks, right? You'd be immediately willing to pay twice as much for stocks as you were previously, because the risk-free alternative, the relative investment opportunity, would have changed dramatically. He explains that if interest rates stay similar to what they were in 1999, so if they stayed around 6%, then you would expect that the prices of stocks would grow approximately the same as GDP over the very, very long term, over multiple decades. So that would mean if interest rates had stayed at 6%, that you would expect stock market returns of around 2 to 3% per year. And if interest rates were to have risen from the 6% to say 8, 9, 10% or even higher, then the return of stocks would have certainly been either flat or negative over an extremely long period of time. So what ended up happening from 1999 to 2016? Well, over that period, interest rates dropped from 6% to 0.25%. So they certainly went a lot lower than what Warren Buffett was expecting or could see as a reasonable outcome in his letter. They reached all-time lows historically, and over that period, the stock market rose approximately 60% in total. And if you compound that on a yearly basis, that's a return of about 2.5 to 3% per year, even though interest rates continue to decline and decline at a substantial rate. So what does the market look like today? And what do these kind of interest rate and profit indicators tell us about what we should expect in the future for businesses broadly? Or how can we kind of think about what to expect? Well, interest rates are still at rock bottom. They are within a range of between 0% and 0.25% for the federal funds rate. And consequently, stock prices are at all-time highs. And they're not not just at all-time highs compared to previous prices, but they're at all-time highs compared to current profits, which is much more interesting than just looking at the price of the stock market compared to previously, because of course, if corporate profits rise substantially, then it makes sense that stock prices are higher, but that really hasn't happened. Corporate profits have risen, but they have not risen at the same rate as stock market prices, and as a result, there is a huge gap right now, the biggest in history, even through all other periods, of prices of stocks compared to the profits that businesses are producing. And what you should understand is that that makes perfect sense in a world where the risk-free alternative is 0%, right? We're not talking about 1980s where the alternative was a 15% return with the government basically risk-free. We're not talking about the 60s where it was about 4% or the 90s where it was about 6%. The alternative for your money right now, if you want a safer option, is nothing. You make no money. In fact, in most cases, you'll be making a negative real return if you take into account the small level of inflation that we've got right now. If the alternative investment is 0%, then you are willing to accept almost anything that is positive from a risky asset. And that means that you're willing to pay almost any price for a business that is going to produce profit and grow their profits in the future. And that's why you have a lot of stocks right now that have a price to earnings ratio of 30, 40, 50. Even now I'm seeing it's not uncommon to see a business that has an 80 price to earnings ratio, which seems insane, but if the business does grow their profits from that point, maybe they will make you a couple of percentage points, and that is still better than what you can get right now from the alternative investment opportunities. So basically, if interest rates were to stay at 0% for a really long time, and this is what Buffett has been talking about recently, if interest rates were to stay at 0% for the next 20 years, then stock prices are not expensive, because the alternative is you make nothing. But what we should think about is what happens if interest rates do change in one direction or the other, because historically they have changed very, very rapidly, and there has been very little periods where interest rates have kind of stayed in the same range. First of all, what would happen if interest rates went down further? Well, first of all, interest rates are pretty much at rock bottom in terms of positive interest rates. Theoretically, they can go negative, and there has been places in the world, such as parts of Europe, where interest rates are negative right now, but that doesn't really make any sense economically for that to be viable over an extended period of time. So interest rates, in theory, like the 10-year US Treasury yield could go down a little bit, but considering that 6% to 1% or 6% to 0.25%, which happened from 1999 to 2016, only produced 3% per year stock market returns, it's hard to imagine that a minor 0.5 percentage point decrease in interest rates from here would have any substantial upward pressure on stock prices. What is far more likely to happen is stock prices will come off their rock bottom record low of basically 0 and rise somewhat. And again, we have no idea how much they will rise in the future, or how quickly, or when it will happen, whether it will rise to 2% over the next 10 years, or 5%, or 10%, or 15%, the highs that we saw back in the 80s. We have no idea to what extent interest rates will rise, but what we do know is if they do rise, it will have a negative impact on stock prices, because all of a sudden we will come out of an environment where interest rates or risk-free alternatives like US government bonds are offering 0% to maybe now they're offering 2%. And even that small change changes the behavior of people when investing in stocks. All of a sudden, you're not willing to pay any price for a stock. You have to think critically about the price that you're paying for a stock, and even that will have an impact on stock prices. Remember, from 1964 to 1981, interest rates rose by about 4 times. They went from 4% to 15%, and even though corporate profits rose 6 times over that period, which is really, really high, strong performance of businesses, the stock market didn't go anywhere. So you can imagine that when interest rates are at 0.25%, that they may be very, very sensitive to changes in the future. And we actually recently had an indication of how sensitive interest rates or stock prices are to interest rates just a couple of years ago. So starting in 2017, the US Fed started to raise interest rates. They rose interest rates over the next couple of years from 0.25% to 2.5%. And over that period, the stock market went down 16%. And It only stopped falling when they lowered interest rates again to 1.75%. Now, again, we don't know what's going to happen in the future, but imagine if interest rates go back to where they have been historically in the range of 5 to 10%. That would have a very, very dramatic negative impact on stock prices, and that's something we should be prepared for when we're investing in this environment. But the most important question is, what can you do about it? I mean, it's all good and well to look at this data and think about what the stock market might do in the future, but what can you actually do to protect yourself? And I think there's two main approaches that make the most sense for investors to consider. The first is that you just continue to dollar cost average, buy frequently into index funds and accept the market return. And even though there has been periods such as that 17-year period where stock prices didn't go anywhere, historically, if you hold investments over the very long term, you intend to hold them for 1, 2, 3, 4 decades, if in the best case for people who are really young, then historically the stock market goes up. And if you're consistently buying over that period, then you're able to accept the market return and basically achieve the return of the growth of businesses as a group. Of course, if you use this method, you have no idea what return you're going to make in the future. You're just accepting the market return. And you're basically participating in the market. So that brings us to the second option, which is to selectively buy individual businesses that are offering a better return than the broader market. To go back to 1999, yes, if you had bought into the broader stock market at that time, then your returns over the next 15 or so years were not that great. But if you had been analyzing individual businesses and being patient because they were really expensive in 1999, then just a couple of years later, a lot of stocks were extremely cheap and offered significantly better returns than what the broader market did. Personally, I do a combination of these things. I have a foundation in my portfolio where I consistently contribute to index funds and just participate in the market, but the vast majority of my money is in a combination of individual stocks and then cash that I have waiting patiently, while I wait patiently for better opportunities to appear, because right now in a zero interest rate environment with everything really expensive, it's very, very difficult to find opportunities. Not impossible. They do come around every now and then, but it is much more challenging to invest in this environment than it would be if interest rates rose over time. And if that is the case, then there will be a very good opportunity to invest in some individual businesses. I hope you guys got some value out of today's video, and I'd love to hear your thoughts down in the comment section below. As always, if you're interested in learning more about individual businesses, then I recommend checking out the 4-step stock analysis playlist on my YouTube channel. I go through in detail how I break down and analyze individual companies. So if that's something that you're interested in, make sure you check that out. But if you did enjoy today's video, make sure you leave a like on the video and hit subscribe if you want to stay up to date with more content in the future. But with that said, hope you guys have a great day, and I'll see you in the next video.